a comment does come in. It says, earlier you had reviewed some of the stock views. I'm sorry, signature tools with some of the stock views, the stock repair and the stock insurance tool. Can you walk through the difference of those very quickly? Absolutely. A moment ago, remember, I mentioned that when I got called away on my MMYT position, the stock was trading at close to about 108, 109. I think it was about 107. It was back here last Friday on the 20th. Okay, so we would have been about here. It was at 108, 108 something. I had sold the 100 call. I was holding the 85 put. Again, I was guaranteed a 23% profit. I made a 35% profit with the assignment. I could have rolled it and made more, but I didn't. It exceeded my expectations as a married put for about 4 months of trade. Now, then this, ironically, I had nothing to do with this naturally, but then the stock plummeted. Okay, so now we're down into this range here, 96. But Kent, let's take the worst case scenario. Okay, this is Kent that asked about the difference between the stock repair and the stock insurance tool. Let's say that I had bought MMYT at the worst possible price at 110. And now we're trading here at 94. That's not too terrible. Okay, that's not too bad. It's only a 6% loss. Hey, I could be selling 100 calls and maybe generate $1.50, $2 a premium on MMYT the way the implied volatility is. That would cut down a third of my $6 loss. Okay, but then I'd have to do it 3 cycles in a row. MMYT only offers monthlies. So I might have to do that if I get $2 for a just out of the money premium. Why am I looking at out of the money premium? I bought it at 110. The stock's now at 94. Why am I not selling the 95 for maybe $3? Well, that's because that would only give me 98 back on that covered call trade. I'd be locking myself into a loss of $12 without having to pay more money to roll up the call and continue it that way. On a covered call strategy, you don't want to necessarily chase this down and risk getting assigned for a loss or locked into a loss. So, what are the benefits of the stock repair? Let's take this example. Worst price, MMYT, at 110. Just a few days ago, honestly. And let's go back and take a look at what that position would be. I'm going to enter it in the portfolio. Let's do a setup real quick. I'll show you how I set up the portfolio. Ignore all these other ones. It's your first time using PowerOptions. You just started the trial. The only thing you'll see when you go into the setup view is new portfolio. We're just going to call this stock, insurance, and repair. And because we're dealing with a $100 stock, let's just put in, we're going to do $60,000 here. Copy that over. And let's say we created this portfolio a couple weeks ago. I'm sorry, let me explain that. The cash on hand, what is my total cash on hand on my portfolio? And my starting basis. Why did I make those equal? Well, when you start recreating your own portfolio in PowerOptions, what I want to do is, I might have 9, 10, 12, 15 positions open in my different accounts. But if I want to view this as a new portfolio, I'm creating a new portfolio to show me and help me with what my broker's showing me. I prefer to use PowerOptions. We show everything as linked trades. I'll get to that in a moment. But if I take all of the value of my open positions, current liquidation value, and my remaining cash on hand, and my total portfolio value is around $60,000. When I'm creating the portfolio in PowerOptions, I'm going to put that as my cash on hand and my starting basis. Because once I start entering positions, it's going to start subtracting from the cash on hand, and now I'll have a better mirror image of what my current positions are versus what my expectation is, my total cost is as well, my total value, I should say. My apologies. So let's go ahead and save that. Now that I've saved it in the setup view, I'm going to link to portfolios, and this is where we track our open positions. We're just going to enter a simple long stock position, and we're going to use, of course, MMYT. And a few days ago, it was, there. We're going to put in, let's just put in 100 shares to keep the math simple. I know I put in 60,000. I was thinking I was going to do 500 shares, but let's just keep the math simple and use 100 shares. And our price per share was 110. All right. Not going to put a commission fee. You don't need to worry about the position name and position description at this time. We'll explain that later on. Or if you want to know more about that, we're going to do it during a coaching session or via email. Let's just enter a long stock position. All right. Issue price 110. We're at a loss of 1504 because the stock's at 94.96. We're down 13.7% or 1504. I'm sorry, just jotting down these numbers. Now, even though I'm just tracking this as a long stock position, or if you're tracking a covered call, married put, credit spread, debit spread, condor position, any position in Power Options you can link using the Edit More Information button to position actions. This is where I would, if I simulated selling a covered call, close the position, edit the position, but I want to go to position analysis. The position analysis, even for a long stock position, is going to give me a breakdown of my current position. We know where we are, all right? We were at that loss of 13.7% after 7 days. And it's not too bad. We're down 1504 in this position, $1,500, okay? So we could make 400 of that by selling the 95 call for October. But look at the percent if assigned. I could get 480 back on 100 shares of my 1,504 loss, but if the stock goes above 95, I have a negative percent return if assigned. That's not what I want. That's what I was talking about, it being locked into a loss. Let's take a look. When I see a rollout opportunity in my position in the portfolio, we can use that more information button against the rollout. We can go to simulate trade. This will give us a side-by-side comparison of our position. We originally had $11,000 invested in the trade, 100 shares at 110. We're down to the 94.96. We're down $1,500 at 13.7%. Now, I can make a third of that back almost by selling the 95 call for October expiration, October 18th for 480. But that only drops my cost basis down to 10,520 or 105.20 for 100 shares. And I'm obligated to deliver shares at 95. That's the loss of 1,020 or 9.7%. Okay, I'm being locked into a loss, selling the at-the-money call, which does give the best time premium. But at the same time, if the stock suddenly gaps up to 100 or 101 on Monday morning, now I've got to pay $6, $7, probably closer to $9, $10 to buy to close that call and then roll to a new strike price. So I'm adding cost basis into the position. All right, that's not the way I want to go. All of these potential rolls, even out to November, even the 49 strike, even the 100 strike out of the money, 49 days out, it's giving us close to $6. Not quite half of what we're losing of 1,504. We'd get $600 back close to it. We'd still be assigned for a loss of 3.9%. We'd have to go out further out in time. And MMYT, does offer other expiration series, but we'd have to go 180 days, 130 days, 230 days to be able to roll for potentially a credit to get the 15 back, and that's not likely to happen. Okay, so now we know where we are. Covered call is not going to repair it. The only hope is that, hey, I sell the 100 call, what did I say? At $2 or $3. I sell the out-of-the-money 100 call at $275. 21 days from now, MMYT stays below 100. This call expires worthless. We now have a loss of $12.25. Okay, so I sell the November 100 or 105 for $275. Okay, stays below 100 or 105. Collect another $275. Now we're still down 1,000, and so on and so forth. Now, I don't know if this repair is going to be available, but let's take a look. Let's go back to the signature tools. Let's go to the stock repair tool. Similar to what we just saw with the long option finder, it's a simple entry. I put in my stock, my cost per share, we're using MMYT at 110, and of course we only had 100 shares on the position. Let's go ahead and submit that. Now, we didn't find a repair for October, but remember what we saw. We were gambling by selling the call option against our security, saying, hey, if I sell the 100 for October 18th and I get 275, well, the stock needs to stay below 100 or I'm going to have to roll the call again. But hey, if it stays below that, I collect 275, then I sell the November, then the December, then the January. I need to do that about 6 or 7 times with a premium of 250, 275 to get back to break even. The other November didn't work, but here's an opportunity in November. to get back to break even with a stock just needing to go up to 99.75. What is this showing me? When you see the repair details button available and analyze trade, that means a repair has been found. Here we see NA. No repair has been found. 15th of November, our stock's at 94.96. At 110.50, essentially we're going to hit break even. Actually, it's 99.75, I'm sorry, but at 110.50, it's still the maximum profit. We can buy 90 strike calls and sell 100 strike calls and get a 50-cent net credit. My cost basis is 110. If I get a 50-cent net credit, that only drops my cost basis down to 109.50. How am I getting to break even at 99.75? Let's take a look at the repair details. When you click on repair details, it gives you a breakdown of the ratio call repair strategy. We know our loss. We bought it at 94. I'm sorry, we bought it at 110. It's at 94.96. We've got our 15.04 loss on the position. The repair is showing me I can buy one 15th of November 90 call for 11.10. And I can sell two 15th of November 100 straight calls 10 points higher for 5.80. So that would bring in 11.60. So I pay out 11.10 to buy this 90 call, and I sell two calls at the 100 strike at 5.80 and collect 11.60. So this gives me that 50-cent net credit. This is a ratio call spread. I'm selling twice as many calls as I'm buying. And you'd see, let me clear that out. You'd see a profit and loss chart that would look maybe something like this. Your break even is here. Well, you collected 50 cents. I'm sorry. So let's clear that up again. Sorry, folks. This is the ratio call spread in action. Okay. I bought a call here at this strike. I sold two here, and I collected 50 cents. So even if the stock falls below 90 and all calls expire worthless, I still keep 50 cents. My risk is I have sold two calls here. So I have a bull call debit spread and a naked call position with unlimited upside loss potential. But this is done against 100 shares of stock, which means now I have a bull call debit spread at the 90 strike and the 100 strike. And I have a covered call position with my 100 shares that I did buy at 110 and a 100 strike sold call. So how is this getting me back to break even at 99.75? Because if the stock's trading at 99.75, what do we have? We have two sold calls at the 100 strike, both which would expire worthless. One is covered by the call that we bought, that essentially we were paid to own for the 50-cent net credit. And the other sold call is covered by the stock position. And that long call that we have, although the two 100 calls expire worthless, it's going to have an intrinsic value on November expiration of 9.75. I collect 50 cents in premium. My long call value is 9.75. That's 10.25, which means what? That would be my loss in the stock. We paid 110. Stock's trading at 99.75. I have a loss of 10.25. But now my two 100 short calls, my obligations expire worthless. The 90 call is worth 9.75, and I took in 50 cents, and now I'm at break even at 99.75. Rather than having to sell that out of the money $2.50, 2.75 strike 6 or 7 cycles in a row to get back to break even, I can get back to break even with the stock only moving up about another 4 or 5% to 99.75. And I don't necessarily have to have an obligation to deliver shares of stock. Now, I know that's a weird view, but that's what it's describing. It's a 2-to-1 ratio. Nothing is naked because one of your short calls is covered by the 100 shares of stock that I own. The other short call is covered by this long call I bought that's at a deeper value. We create a bull call debit spread with a covered call. If you go to Analyze Trade, we're going to see that graphically, and that might be the better view. I have stock at 110, bought a 90 call for 1110, sold twice as many, sold two 100 calls for 15th of November for 580. That brings us in the 1160, that 50-cent net credit. We lower our cost basis by only 50 cents. But now at 100, where we'd still be at a $10 loss on our trade, a $1,000 loss on our trade, with this repair, because of the difference of the 90 strike to the 100 strike, we'll be at a profit of 0.5%, with the stock just having to move back up to 100 instead of 110 in that 49-day time period. Rather than rolling for 6 or 7 months with a 250, 275 strike, out of the money 100 call, just to keep doing that and doing that, in 49 days we can get back to break even. Now, some cons of this position. Hey, it gives us a profit. It gives us a little premium, not a great hedge. It gets us back to break even much faster than holding and hoping or selling calls against. Of course, the stock could erupt, and we've had a couple questions on that recently with gentlemen who've done repairs and I had coaching sessions with last week. But if you take a look at it, yes, the upside is capped. But remember what I said, this is essentially a covered call with a bull call debit spread. So if you do enter a repair, so I've got my bull call debit spread, my 10 strike difference, 100 sold call, 90 strike bought, and I have my covered call with the 100 sold call. So what happens if on Monday or Tuesday the stock rebounds and exceeds our expectation and goes up to 106? Well, I'm still going to leave this open. The bull call debit spread, the long call and the short call at 100. Because as I get closer and closer to November expiration, this is going to get closer and closer to that full 10-point profit, where I can sell to close the 90 strike, buy to close the 100, and I'll get $10 back on the position. But what about this other sold call that we have? We have 2 sold calls now. That's our covered call. Well, I might track this in the portfolio as a covered call with a bull call debit spread, not necessarily the full ratio spread. Track them actually separately. So now as the stock moves above 100, what am I going to do? The same thing we did a moment ago. On my covered call, I'm going to go to position actions, position analysis, and I'm going to evaluate just rolling this one strike of this 100 call that's against my 100 shares of stock. I'm going to keep treating this as a covered call, but keep this there until I get 85, 90% of the expected $10 profit I make on the bull call debit spread. And that's how I'm going to approach it. And that's, of course, the power, Kent, as I mentioned, of the stock repair. We saw how long it would take, theoretically, 6 to 7 months to just sell calls against it, getting that 275 to be out of the money. So to make 1505 back, yeah, it's about 6 different cycles. 6.5 maybe, or the stock repair gets us back to break even with the stock only being at 99.75. Yes, it was a small profit if we allowed it to be assigned, but we don't have to allow it to be assigned. Okay, we can keep making. Oh, I clicked on the wrong repair. I'm sorry, folks. I apologize. Analyze trade. That was our November trade. I am so sorry. There we go. It's only a 0.5% return if the stock's above 99.75. But hey, like I said, if the stock just went to 101, I'd have a 0.5% return on this position in 49 days. Whereas if I did nothing, or if I just managed to sell that October 100 strike we saw at 275, then the November strike, let's say at 285, let's just call it $3. The stock at 101, we'd be down $8. We only collected $5.75. $9, we'd be only at $5.75. Sorry. So we're still down about $4, $4.25. Here would be a break even. And if it does gap up, you'd manage that one short call just the same way you'd manage a covered call if you want to stay in the position and not get assigned and still keep rolling the trade in that way, but leave that bull call credit spread portion open for longer term.